Good day everyone and welcome to today's webinar, Learn How Money Management Techniques Can Improve Your Trading. My name is Nenad, Chris is with me, and we will talk about different techniques including imbalance hedge that I promise to show you so you can actually improve your trading techniques. So before we begin, this is me, this is Chris, and we are trading with other markets. CFD and Forex trading are leveraged products and can result in losses that exceed your deposits. And have in mind that this video is not part of the .co.uk website, but the globalnews.com website. Please read the full risk disclosure, and you can proceed further with us. So my agenda will be stop losses. I will tell you a few things, important things about stop loss placements, then ATR, and so-called imbalanced hedge. So these kind of things should improve your money management, and definitely my opinion is that this should provide you with a better understanding that trading is about how much you're willing to lose, not how much you're willing to win. So the advantages of using stop losses, I personally want to go with this subject because I have heard that a lot of traders simply don't use stop loss, and I really don't know why it's the case. I have always used stop losses. I have different techniques to manage my trades, but really without stop loss placement, I think that we are not trading then. We are actually gambling. Because I guess I'm not sure that how many people actually worked for a company that did trading for investment accounts, and I did it some time ago. And actually when you're trading with big funds, you always have a risk compliance manager that actually tells you how much you should risk, what is your daily risk limit, what is your weekly risk limit, and what is your monthly risk limit. Whatever the case is, you should never ever exceed your monthly risk limit, because monthly risk limit is also calculated in per annum sheet. So if you, let's say, have a limit of 2% per day, then you exceed somehow that limit, it means that probably your trading will be disabled until the end of the week, because it's the rules. No matter if you work for the company or not, or you are trading your own funds, you need to understand one thing, and you need to treat your account as if it were a professional account, an investment account. Treat it as if it's just your investment. That way, you will probably start to think that placing stop is a must. The biggest problem is that if you don't use stops on leverage trades, I think that especially if your funds are limited, that will end your career in Forex trading. And the biggest drawdown of that is people like to trade. People enjoy trading, because a lot of times in the past, I mean, traders can earn a single salary, 1 month salary in a single trade. And that is what traders keeps motivated to trade. But majority of traders simply don't know limits of trading, and they always think that they will earn every day, every time. That is simply not the fact. More often than not, I need to say that we are really on the verge of having a profitable day or month if the market is not grateful to us. When I say grateful, I particularly mean about trending market, because I'm a trend trader, And when there is no trend, well, you know, guys, I simply cannot make a lot of money unless I'm trading and taking trades with slightly higher leverage, risking up to 5%, let's say, of the overall account. Of course, as I say, it's not the same if you make 5% on $1,000 or $10,000 account, or if you make 5% on $100,000 account. It's the money, you know, guys. 500 or 1,000 per day equals to, let's say, 0.5 to 1% for a day on a $100,000 account. But you know, if you make only $10 on a $1,000 account, I don't think it will make you happy, right? So first of all, you need to understand that whatever you do, placing stop loss is the first thing that you should do, because it will keep your equity safe, and at least it should keep you longer in this game. This connection in this business, I need to say, because for some people this is just a game because they have other investments. For other people this is their job. For some people this is a hobby, this is a job. For me this is what I am. So placing stop losses, okay, is definitely a must. Disconnection proof. What if you don't have a stop loss? There is some big impending news and you are getting disconnected and you cannot place a stop loss. I mean, it has a big impact on your nerves, and because you just need to know what it will bring, especially if you're keen to trade that particular news. Platform and functioning proof, unless you're running a VPS, virtual private server, that you can purchase directly from the MT4 platform, you are prone to platform malfunctioning proof. I mean, really, throughout trading with other markets, I haven't had, really, I just cannot remember when I had any problem with platform malfunctioning proof. The system is working great and I'm pretty much happy with it. But I know that a lot of you simply don't have a lot of experience also in trading, so you always need to have a stable platform, and especially if you're running an expert advisor, you need to have a VPS. It's a must. Disadvantages of using stops: some brokers that are not fully regulated, they can manipulate with stop loss orders. Back in days when I started to trade in 2008, I remember there was a lot of talk, and this market was still a bit unregulated, and today it's a different thing. We are always getting some new regulations, and definitely traders are protected now today more than ever. At least from what I know of, and I've been in this business for, well, almost very close to 10 years. So the thing is that back then when I started to trade, some brokers exploited stop loss orders of some traders, and they're actually hunted stop losses. Today's practice for regulated brokers are definitely they don't do that, and I'm pretty much sure, and I have also proofs that other markets doesn't do that. I just remember a lot of times my stop was not hit, guys, for 0.5 pips. It's incredible. Usually when something misses 0.5, that is the proof for me how things work with Admiral, and I'm very happy about it, really, because I trade each day, not each day literally, but let's say at least 4 times per week I make a trade. Psychological failure when stop loss hits in reverse, also very big impact on your psychology, because you can say, okay, if I had let this trade running, I would have made profits. No, it's not good thinking. You should not think like that, because who knows, maybe if you had let your stop loss, your trade go with a big drawdown, maybe you would have lost everything in couple of days, or in couple of hours, or in couple of weeks. Who knows, guys? I know that traders, particularly my opinion is that traders lose money simply because they don't follow the rules. Of course, if your system is not that good, if you're not seeing what you should be seeing when trading, then, well, you will probably, and if your money management is good, you can make it to break even. But if your money management is bad, and 95% of traders simply have bad money management, in my opinion, then losses are, well, they will happen each day, each month, and traders will not be profitable. The biggest drawdown of a stop loss is psychological question. Are you really that sort of trader that you cannot cope with your losses? It's, guys, first think about it before you start any money management plan. If you don't have a money management plan, you cannot do imbalance hedging strategy. You cannot do martingale. You cannot do hedging. You cannot do grid money management strategy. So placing stop is the first thing you should learn to do. Then we come to money management things. Okay. Also, a lot of traders like to use very tight stop losses. I don't particularly do that because it's not about how big is stop loss. It's about how much of a risk you put in a stop loss. So if your stop loss is 100%, your risk can still fit into that 100 pips of a stop loss. Let's say that I am willing to risk 5% of my account. So I can risk 5% of my account in a 100 pip stop loss, in a 50 pip stop loss, and in a 30 pip stop loss. Rarely I have a stop loss less than 30 pips. Sometimes it's 20, but it's very rare. And I just calculate how big my volume should be, how big my lot size initial should be in order to do that, to cover for that 5% of risk. Because when you start your trade, you need to decide how much you're willing to risk, not how much you will win. If you reverse it, if you think how much you're willing to win, then you will lose. It's simply the fact, and I can prove the fact because I've been there. I know I've been there. I was there. Okay? And I know what I'm talking about. I'm talking, again, from my personal experience. We always, when we start to trade, especially if you are new traders, and I know that a lot of new traders are listening and to us and will listen to us on YouTube because this webinar is being recorded and it will be uploaded. I know that a lot of traders start to think, okay, how much I will win. And people who came to me to manage their funds actually ask me, Nenad, okay, tell me how much I will make if you manage my account. That is the question that always has the same answer. Okay, I always say, and I give just a reverse question. How much? No. First, tell me how much you're willing to lose. And if he tells me, oh, why is that question? What do you think? How much I'm willing to lose? I know that that kind of trader or investor simply does not know a fact about trading. I am not managing anyone's money until a person tells me how much he or she is willing to lose. How big is a relative drawdown? How big can be a floating loss? Everyone has their own limits, guys. Okay? It's the fact. What it means that of 1,000 cuts. Constantly trading with small stop loss that gets hit each time. Multiple times position is opened. I witnessed a trader who lost tons of money for having very small stops. It's nonsense. Your stop loss can be 1,000 pips if your account is big enough to place maximum 5% of risk in that 1,000 pips of a stop loss. Remember, the risk is fixed. Stop loss is dynamic. Remember what I'm teaching you because this is the fact. Okay, I really am into this 100% and I want you to know how things are going here. Methods for placing stops, technical, percentage, confluence stops. We already talked about this. I will just mention it briefly. Depending on the type of trade and your risk portfolio, you need to determine your stop loss. Technical stop usually is what I use. It's a swing high-low candlestick, most common, and most traders use it. But again, guys, let's say, for example, that this is my technical stop. Let's say today I traded euro dollar. You can check my Twitter, you can check my Instagram, you can check my Facebook. I posted a trade monitored from my mobile phone on one of my accounts that is a big account, and I posted it there. So I just posted a trade, but I used a proper money management. So if I use technical stop, and if I put 10 pips above the last high for a short trade, it means that, let's say my stop loss is 30 pips, right? And then how much did I put into this stop loss of 30 pips that is technical? I was willing to put 5% of risk, okay? Because I was willing to make that trade particular because I was 80% sure it will get to my, again, Camarilla, lower part of Camarilla, daily L3, whatever. You know that I'm a big fan of Camarillas, and I'm really into that a lot. So the fact is that technical stops always need to have risk pre-calculated before you place your stop. What is percentage stop? Well, if you don't use technical stop, you can opt for an equity stop. For example, you can say my stop will use 1% of my account. It's good because then you're actually learning that trading is about risk, not about how much you're willing to win. Either way, you will win. If you are correct in your trade, whatever leverage you use for a trade, whatever volume you use for initial trade, if you're correct with your trade, you will win. But if you are not correct with your trade, or not because you're a bad trader, but simply, guys, it's market, you know. You cannot be a master of markets. You can just follow markets. But market will always do its own thing, its own bidding. So equity stop uses predetermined percentage of traders' account. 1%, let's say, is enough for novice traders. New traders, listen to me. Use 1% of your equity stop, okay? And even if you lose, you will learn by losing. I am willing to risk 5% maximum, okay? I, personally. But still, you know, everyone is different. When I spoke to my friend who is full-time equity trader, he tells me that he never uses 5% of risk. Well, obvious, and he told me his risk is much higher. But yeah, he's been working also with constantly. He has a surge of money getting into his account, so he is basically reinvesting. He uses reinvestments, so he doesn't use everything that he has for trading, so he can allow a bigger risk. Usually, investors who have other jobs that are a lot of profitable, let's say housing market, or they work with other profitable commodities, they can reinvest in forex market, and then they can use bigger risk. But remember, how much you want to win, that is how much you're willing to risk. If you really want to make 60% in a single month, then you should be willing to risk 60% of your account. It's the fact. Good position, percentage stop is good for positional swing traders who want to use a predetermined equity stop. Possibly you won't be having too many entries, because if you use your full allowed risk in a single trade, then you need to keep that single trade running. You should not add any positions, any trades, because it will increase your risk. It is a form of arbitrary stop loss. So before you make a trade, calculate your risk. When you calculate your risk, then you make a stop loss, or you make an equity stop based again on your risk portfolio. Percentage stop, this is just for example. This is not written in stone. Typical stops are 2% for intraday traders, 8% for intra-week trades, okay? So 2% for intraday trades, 8% for intra-week, 15% for monthly trades, 20% for investments, okay? And if a long trade is entered at, let's say, 1.250 and you have 2% of stop loss, you should be place your trade at 1.225. So that is how you calculate this percentage stop, 25 points lower than the entry price. But usually, guys, people who invest, they say, okay, my maximal drawdown is 20%. Some people will tell you 40% is the limit. So types of trades, I will just go with this and then I will go to and show you imbalance hedging, how it works. So before you make a trade and place your stop loss, you need to know whether your trade is positional, is it a scalp, is it a scalp swing, is it a breakout, is it a counter trend. Usually positional trades, trend trades have the biggest chance to win. So you can opt for initially, maybe, let's say if your risk is 5% per day, you can go with 1 or 2% for your position. Scalp is very, very dependent on risk. Usually scalps are done with full risk limit. Or if you want to be like active scalper, then your trades should be divided. Let's say if you make 6 or 7 scalps per day, divided by, let's say, 0.7% of a risk. Scalp swing, a term that I use for something in between intraday trade and scalp. That is what I did today with euro dollar. Well, usually you can allow also 5%. Breakouts go to 5% because those are very fast trades executed usually as a trigger happy trades, or breakout retest continuation, BPC pattern, right? Pullback continuation. And counter trend trades. Counter trend trades are risky because you're going with retracement, okay? So if the pair is going down, you don't know if a counter trade opportunity is a retracement or a reversal, because reversal usually comes after retracement. So have in mind that your counter trend trade is likely a retracement trade. So if you lose it, then probably you won't be having a lot of chance to go with another counter trend trade because the price will proceed in trend direction, okay? So usually the risk for counter trend trade is less than other types of trades, around 1% per trade, okay? So let's go now to just quickly, because I can see that it's already 6:25. Quickly we will go to different account types. Also, you need to determine your account type. Is it a low to high account? What does it mean? You invested 300 euros and you want to make 1,300 euros, as I did like 6-7 months ago, and I do it from time to time. Not always, guys, but from time to time. I can manage to double the account. Not always making like triple, but doubling the account is okay. Then I withdraw the money and so on. That is a good thing to make initial investment very, very profitable and easy money if you know how to do it. But you know, it's like you should treat this as one part of investment, let's say one-way investment. Because if you can risk 300, in order to gain 300, you must risk 100% of your investment, and it means just use the money that you don't need, okay? Then whole account risk is gambling. If you really want to make 10,000 out of 10,000, that is like you're using your whole equity basically as a risk. So you need to be prepared either for a big win or a big loss. Investment accounts usually use lower risks because investing is different from trading. You have a blog about investing. You can check it on Almer Markets website. So it's different. Investment accounts use very low risks, and usually they're longer term. Compounding account account that you use for compounding, you are adding profits to profits. It's a very profitable technique, but you need to know that you should never ever pull the money out of your compounding account unless you reach your goal. And finally, institutional account. Well, institutional accounts are run by prop traders, hedge fund traders who have their own risk manager to tell them how they should treat their institutional account. Okay. Now, about the ATR, and then I will show you what is imbalance hedge. So, how do we use ATR? This is important, guys, very important. Volatility, range, and targets. That is very, very important, guys, because a lot of traders simply neglect the fact that they don't like to use ATR indicator. I mean, I know that most of you surely do it because you've been, you've been trading, you've been coming here with me, visiting mine and Chris webinars, and you know that I've been always using this ATR, and for me it's immensely important. Okay, and let's use this example. Here you can see the ATR for dollar CAD. Okay, just as an example, it's like only 90 euros, right? So what does it tell me? It tells me that if I know that it's August and I know that market is not very fast, you see it's only 60 days today. So if I see that 90 is for last 40 days, today is 60. If I want to make a scalp trade, I can go with 12, 15 pips, 20%. It's okay. First, it's summer. Okay. First, it's summer. And another thing is we have low ATR. So I will use my own technique. Pound yen, different kind of beast, right? Pound yen is very volatile. 117 pips, today 160. So I know that I could probably make a counter trend trade if I get the opportunity by using divergence and so on, because the price is already overshotted it, and I would be aiming for, let's say, 20-30%. Again, it's like much more than dollar CAD, right? It's like 48, 50 pips. So, you need to watch it. The ATR will tell you. Let me just show you the ATR without all of these indicators here. So, just give me a few seconds and I will clear all this so you can see the ATR. It's very important. So here again, you see, we have I will use, let's say, pound dollar. Okay. So here we see the ATR top, the ATR bottom. When this yellow pivot point is above or below the projected high or low, it means that the price has been overshot. Like in this example, you see how both blue and yellow are above and below this dotted line. So it means that the price has overshot. Okay, and it means that the range has been broken. But the ATR is the best volatility indicator for me. It tells me everything. Contrary to pound yen, Australian dollars, we see very low range. So if I decide to scalp it, you see 45 pips. I would probably go with 9, 10 pips. 73 pips of ATR, 20% is 14 pips, right? Let's say roughly. Today's range is 45, so I would even be happy with 10 pips. You need to watch the ATR. You cannot say, okay, like a trader commented on my Facebook post today, big money, low number of pips. Of course, it's low number of pips because the euro dollar simply does not have big ATR. Why should I go with something that is very slow? Of course, when I scalp, I use my risk, and again, not just risk, but also according to my stop loss placement, I also take profits. If I see that the ATR is 73 and 45, I'm happy with 14 pips if I do scalping. If I do, let's say, positional trade, I would go with, again, 20%. It's summer, so anywhere from 15 to 20 pips on this pair. Of course, compared to pound yen, where I can go to even 50 pips because it's huge. I mean, not huge, but much better than Australian dollar Swissy, or let's say Euro New Zealand. Watch this, guys. Right? So it's nice, you know. ATR is great. And finally, what is imbalance catch? Again, you need to learn about stops. I hope that this will help you, about your risk portfolio. You need to learn about yourself. What type of trader are you? If your trade is good, you use trailing or profit stop. That is how I do it. But if your trade goes in a loss, you use imbalance catch. This is how it goes. Let's say that this is the zone of 50 pips, the average 50 pips for trade. So you are buying 0.10, but you lost your trade. Then you're selling 0.20. You're losing your trade. Again, if everything came into a loss, this is just an example. Okay? So after 10 losses, okay, here, your maximal drawdown, let's say, is 22% of the account. That is how imbalance hedge works. It's not a martingale, but this is something different. You need to calculate how much you are going to lose with 10 trades in a row if you lose every single trade by using imbalance hedge strategy. And if you can afford up to 22% of a drawdown, when every single of your trade is a loss, like this, okay, then you will only lose 22%. You need to know your maximum, what is your maximum loss limit. But have in mind that imbalance hedge strategy can work pretty much successfully, and I have been personally trading it, and I have a robot that does it for me. And again, on some accounts, it's very nice, but you need to let it run. And usually trades are ended either on a break even or in a small profit but they don't end in a loss. Usually those kind of money management, that kind of money management is used on investment accounts. It's called imbalance hedge. Okay. Then again, let's say that your trades are simply as they were, and this last trade gave you profit. Every single of these orders should be closed immediately, and again, you will be in profit. That you need to determine where is your break even, where is your profit target to the both sides. As I say, there are a lot of helpful tools, expert advisors that can do that for you. Thanks, guys, for listening. I will talk more about imbalance hedge on our future webinars. We don't have time to cover it all. Chris will continue. And of course, I mean, at least one part of a trade you saw yesterday on my live trading session. So, well, it's something like that. Not like total imbalance hedge, but, you know, I did, let's say, a trade that was based on this. I had a loss on euro dollar long, if you followed my webinar. Then I had a win on euro dollar sell, but I didn't risk much from my equity, right? So usually this ends up in a profit. Thank you, guys. I will talk to you soon. Follow new analysis. Tomorrow we'll publish a new one, and of course see you next week on live webinars. Cheers, everyone.
Thank you so much, Nenad. Great stuff there from Nenad. Always lovely to hear him, isn't it? And next week, indeed, we're back. Looking forward already, taking a look at the market. Couldn't be better, in fact. So, yeah, just not looking at the market this time, indeed. Nenad covered so much that I think my part will be a bit shorter. But, yeah, basically, some things maybe just to add here and there as we go along. Some slides here explaining money and risk management. Indeed, you want to think about not only, just to emphasize, not only what you're basically trading with, but you want to keep certain things in mind. What is your total risk capital? So what is your total capital? So what is your total net worth, basically, and what part of that is liquid? So what part of that is not tied into perhaps some long-term assets, like, for instance, housing? So what can you really trade with? What kind of savings can you trade with? Or, what savings do you have, right? Liquid. And what part of that would you like to trade? And this will be debated. This could be different. Some people might say only trade with 5% of that. Others might be more risky and say, okay, try 50%. So, for instance, if you have savings of 10,000 euros, for instance, how much do you want to actually trade with, right? And that answer will definitely depend on your risk profile, depending who you ask, etc. My view, well, on average, I would say definitely anything on the lower end is good. I mean, if you trade with 1,000 euros, I don't think that no one will say anything harmful of that. If you go higher, if you go up to 5, yeah, that's already quite a lot. It might also impact your psychology a bit. So, anywhere between there is a bit of a gray area. I would say at 2, 3 is still probably in balance, but maybe not for everyone. It really depends on your own psychology too. So, but whatever you choose, that's your trading capital. So of that trading capital, right, you will put the capital on an account. You don't have to do everything. If that capital is 10,000, you don't have to put all the 10,000 on your account. You could choose to do 2,000. Your trading capital is actually larger, but you don't have to necessarily put everything. It depends, again, partly on your psychology. I spoke to a trader. He said, I keep losing my risk management cool, and I keep over-risking at one point or another. I can stay patient for a very long time, but there's just that one moment where I go overboard and I risk too much. It was asking me if I had a tip, and I was saying that one way could be to, rather than take a low risk percentage on a high all of the risk capital you want to use, you could use a lower capital but a higher risk percentage. So, for instance, let me work with some examples here very quickly. I don't have my drawing to open. Just give me a second. For instance, if you have 10,000 capital, right? So instead of putting all 10,000 on it and risking 1%, all right, let me show you. 10K, 1% risk. So that is 100 euros or dollars, right, that you're risking per trade. So instead of doing that, instead of 10K, one could say, okay, I risk 1K. For instance, this is hypothetical, but I take 5% risk, the max kind of that is normally accepted, and that is 50 euros, for instance. Or you could even make it 2K, 5%, and it will be still the same 100 euros, right? Depends. So for some traders, they need to risk a bit more to feel like they're engaged with the trade. Otherwise, they're not sensitive to what's going on, and they might be careless. Others are the opposite. Others might need to reduce the risk because otherwise they get too nervous. I think in this case, this trader is probably not sensitive that much to risk, perhaps. And that's why he feels the need maybe to risk more. Could be a reason, to think about. This could solve that a bit. You're still taking the same risk, but ultimately, even if you lose the 1 or 2K, there's still 80 or 90% left of the capital. So those are some things you can think about. The leverage, risk parameters, how much you risk per month, per day, per trade. And this is good to think about so that you kind of steer yourself to a situation that even if you lose, that you don't risk, even if you lose what you risk, you're in total not losing more than you like. So this is important so that we don't, because the problem is once you cross this mental border and you lose more than you actually plan to lose, then it's a slippery slope. Then it's very difficult to stop yourself, because then revenge trading is really one click away. Because then, if you don't stop, then you take another trade to get your money back, you take another trade to get your money back, you take another one, and then it might be over. So it's very important not to get down that slope, not even to start it. That's why don't tempt yourself in a way. Keep it very strict. These parameters will help with you with setting up the borders. And you don't want to cross those borders, because then, as I said, it's the slippery slope of starting, and then it's so difficult not to slip. I think that's probably these two things could be good ideas to avoid, to avoid over-risking and managing that. Generally speaking, using fixed risk percentage is better for streaks, against losing streaks. It helps with winning streaks. So it's a good thing to do that. I mean, I know that traders like to use lot sizes, fixed lot sizes, but risk percentage helps a lot with that. Be aware of your average win and average losses, of course. I was listening. I couldn't listen to the entire Nenad's part, unfortunately. I was I need to do something, but I heard Nenad talk about reward to risk. So I think he already mentioned this and touched this topic, right? But basically, good to be aware of not only what are you aiming for as a reward to risk, but what is your actual reward to risk, of course. What is the actual average loss win for your system, when backtesting, for your real performance, with forward trading, forward demo trading, forward real trading. Find out that statistic, know those stats, and maybe you're cutting your losses short, for instance, right? And you see that your wins could have been higher if you followed your system. So this is very good data, because then you'll be maybe more patient with your trade, and that will help the money management. That will help the reward to risk ratio, I should say. Lot sizes, very important to be aware that you need to adjust your lot size. Of course, if you use risk management and basically you just want to calculate how much you want to risk in terms of dollar or euro per trade, whereas the technical stop loss, so that's a very important part of any trade management or money management, depending how you call it, is to use a technical stop loss, not a fixed stop loss. That's our opinion, at least. Using a fixed stop loss, always using 30 pips, is not really using the market structure, not using tops and bottoms, not using highs and lows with not using their benefit, not using their information. That 30 pip stop loss could just be right in front of an even level. Why not use that round level as an extra barrier and put the stop loss 10 pips further? That helps your trade and the success of that trade. Technical stop loss uses a technical level or a technical confluence. It's something that you see on the chart and gives extra support or resistance. Use that, calculate the pips, and then realize that with 1 mini or 1 micro, 1 standard, how much you're risking. If that's too much, reduce the lot size. One thing indeed Nenad talked about at the end is what type of account. Is it more an income account? Are you trying to build up an account? Try to find that balance into withdrawing money, withdrawing some profit, and leaving it there and growing. That is something very personal. Generally speaking, though, I think it's a good idea to have a target of your account and to withdraw a little bit. Even if you want to build up the account, set the goal, and if you hit that goal, take a little bit away from that and then set the next goal so that you really book it, because then it really becomes real. It's tangible. Whereas otherwise, if you just see numbers on a screen, for some of us, it doesn't feel as real. And once again, it really depends on the psychology. For others, those numbers are real, right? It doesn't matter. For others, it's not as real as if it really goes to their account. So if you're one of those type of traders, you might want to think about that. This is, let's see, trade management. Now, then I talked about that, the volatility indeed, so I don't have to go into that. That makes all sense. Of course, you want to be in tune and in sync with what the market is showing. Obviously, that's how it goes. I mean, that's using all the information available to you. Why do it any other way, right? Some other techniques, whether these are money management techniques, it's a very broad kind of term in a way, but anyhow, scaling in and scaling out is our techniques. Trying to cut the losses short, letting the winners run. Also, very famous technique. So basically, I think that is very difficult to do for traders, letting winners run and cutting losses short. I do have a great tool for that, for letting the winners run. It's called Wiz. It's for free. Anyone here joining can get that. It shows exactly where the space is, where the larger momentum could be expected. So I highly recommend that. I'll send my email through the chat, and for those webinar viewers, I'll try to add it soon. All right. Cutting the losses short is a matter of trade management. That's a separate webinar. I highly recommend going to Admiral Markets YouTube channel, looking for trade management, and you'll see exactly how Nenad and I tackle trade management. But you can do a lot with that. If you do that, you will also really aid our performance. Scaling in, scaling out. I'm not a big scaling in fan. Scaling out, yes, sometimes indeed good to grab some profit from a psychological point of view and let the rest run. Especially if you're starting out, intermediate trader, that's good. Some other things you don't want to do is double the risk every trade. No, it's better to have consistency. Take profit indeed. And here's some things you don't want to do. There's a slide here that says more than 10 to 20% of your savings. So I was mentioning 5 to 10 is conservative. Anything to 50 is, riskier. Here it says 10 to 20. So no loans, of course, not good. Do not do that. And some other things here. Watch out for overhyped returns. Let's see what else here. Yes, and be careful, of course, when making any transition from part-time to full-time trading. Be on guard for that, all right? Check yourself. Are you ready? Do you want to test more? Do you want to trade more? What are your results, etc.? All right. Thanks so much for joining. And then I already said it, next week we're back. We're looking forward already. You can check out, of course, Admiral Markets. A lot of good things there besides webinars. You have analytics. You can check out the instruments, tons of instruments, including cryptocurrencies, commodities, CFDs, and of course, software. The MT4 Supreme Edition, specially designed by Admiral Markets, not only offers the standard MT4 things, but on top of that, 60 plus extra features. So you can check it out at admiralmarkets.com. Here too, some other ways to connect to us. And if you're interested in that Wiz tool, you can reach out to that Hotmail address, actually, Chris_Swarsik. That's the one I wanted to add, and it's right here. And wish you all great trading. Cheers.